Hello, good afternoon, everyone, and welcome back to this 19th episode of Yashaswini and Idol. And we have completed about 18 episodes, and I'm happy to share with all of you. Today, we have with us here Smita Patni, who will be going us through the budget, which has proposals of the budget, which has been introduced yesterday by our Honorable Finance Minister. Everyone is knowing the what the tax rates mainly on the capital gains. The definition of capital assets has been changed, and the indexation benefits has been gone, and the 2 years the rate of tax for short term and long term capital gains have also been modified, and the impact will be we may be thinking 10% has gone to 12.5%, and 15% has gone to 20%. However, the impact and the revenue of the government will increase drastically by this. And even if the salaried people are beneficiaries because the tax for them has been reduced, however, the new tax regime is saying no rebates will be allowed. So, what will be the impact? And let us have the analysis of this budget from Smita. So, welcome, Smita, and we are awaiting to hear you out about the income tax proposals on this budget. Similarly, we have the second session uh, on GST, and yeah, and that will be 1 second. That will be taken by Shubha Rawat. Hi, Shubha, welcome to you. And Smita is from Delhi, and Shubha is from Mumbai. And I welcome all my dear moderators. I can see Pradnya, Pooja, and Nikita, who are from across India. So I think they're first time coming to Yashaswini as a moderator. So welcome all of you and my all beautiful chartered accountant women participants. I am sure today's deliberations will help you a lot and upgrade your knowledge also. In this busy season of July income tax return filing, and today also we are celebrating as the income tax day. That is 165th income tax day, and we are celebrating that also today in this busy season of return filing. I know that a lot of issues are coming while filing the return, and site is not working properly. But with the communication of various members, what I understood that at night site is working very smoothly. So I think we have to work now at US timings. So let us learn today and work is for US times. And friends, let me also share with all of you that we had a wonderful, successful CA Women Leadership Conclave, which has concluded in this 29 June. And now we have three more such leadership conclaves, which are scheduled on 3rd of August, that is Saturday at Navi Mumbai, and 4th of August at Bhayandar, and on 10th of August at Thane. So I welcome all of you to invite all of you to all this women leadership conclave, and we will be hearing the successful women in this conclave. A lot of professional opportunities in industry, in practice, as well as in startups and entrepreneurship. We have designed that it motivates everyone and recognizes the leadership. Less than 3% of the women, CA women, are at leadership position, and my agenda is to motivate all the women who are not working to come into the main workforce and who are working to take to the next level. With that agenda, we are coming out with various initiatives. I want to all of you to take participation in all my initiatives. With these words, I welcome all of you and wish you a very happy learning on this 19th episode of Yashaswini, that is a successful women and idol, that is inclusivity, diversity, outstanding performers, and leadership, which all the women CAs possess in their itself. With these words, welcome all of you and over to my moderators. Thank you very much. And this is CA Preeti Saula, Chairperson of Women Members Excellence Committee of Institute of Chartered Accountants of India, as a Central Council member in front of you, hearing out the next sections on this budget. Thank you very much.
Thank you so much, Preeti ma'am, for your opening remarks and highlighting how today's two sessions are going to add to our knowledge. And once again, thanking WMEC committee for scheduling all these webinars and helping out the women chartered accountants to excel in their work and bring them back into workforce. Good afternoon, everybody. I'm CA Pradnyaba. Today, I have an esteemed opportunity to introduce our first speaker for the session Budget at a Glance 2024, CA Smita Patni. Smita Patni is a seasoned professional with 25 years of experience in the accounting and taxation domain. She's a member of ICI and holds a law degree. She has been a professional for past 25 years and is a prolific speaker and author and has contributed to ICI publications and also serves as visiting faculty for ICI's Diploma in International Taxation. Currently, she is nominated as a special invitee for the Women Members Excellence Committee of ICI. So, without further delay, I would like to hand over the session to Smita ma'am so she can start her session and give us an idea of brief of what Miss Finance, our finance minister has changed in yesterday's budget. Thank you, Smita ma'am, and thank you again, WMAC committee.
Thank you very much for the kind words and a very good afternoon to all of you. At the outset, I profusely thank Preeti ma'am, the chairperson of WMAC, the organizing team, for providing me an opportunity to share and present my views with our learned fellow professionals on the proposed budget amendments through this eminent platform. It's indeed an honor and a privilege. Budget 2024 brings Willem E. Simon words in my mind. The nation should have a tax system that looks like someone designed it on purpose. Today, on this eminent platform, which is specially designed and run by the women, I would like to highlight that wherein the Honorable FM has brought about the slew of measures, there is also a special reference in her speech on women-led economy, which continues to be the ongoing theme, with an allocation of INR 3 lakh crore for schemes benefiting and promoting women-led development. On a direct tax front, the abolition of angel tax and equalization levy, reduction of corporate tax rates on foreign companies are incentives to attract foreign investors. Alignment of holding periods and parity of tax rates in capital gain are welcome moves, whereas removal of indexation in the long-term capital gain on immovable property may stifle investments in the real estate sector. There are close to around 100 amendments in the budget 2024. And through this eminent platform, I would try to bring around the prominent proposals in the time allowed to me, and will try to do justice to this topic allocated to me. So I'll just share my screen, and we'll start with the budget proposals. So. Reshare it. I'll just reshare it. There is some problem. I think there is some problem. I just reshare the screen.
वीनू प्लीज हेल्प मैम मैम वो स्क्रीन आपकी ठीक है बस आपको हैंड आउट हो रहे हैं आप बस उसको स्लाइड शो पे क्लिक करेंगे तो डेट विल ओपन
Now is it visible?
हाँ या
full screen ke liye, actually that is what I was trying to do, but again it went out. Is it okay? No, it is not. I'll just do
Like shape, huh? Cup like shape.
Now can you see it? Yeah. So we'll straight away go to the proposals. So first I'll introduce with the personal taxation. So we will have in the personal taxation regime, existing provision for the new regime has been changed. The slab rates have been changed. Now there are the revised slab rate. The only difference is about 10,000 rupees saving in this. Overall, we'll have 17,500 savings. In case we add 50,000, there is an increase of 50,000 to 75,000 in the standard deduction. Again, opting for the new regime. For the old regime, there is no change in the standard deduction. For 80 CCD2, that is applicable for the NPS private sector. So for private sector employees, the limit which was there as 10% has increased to 14% now. So there is a consequence. So even in both the regimes, that is in the old regime as well as the new regime, there is a benefit to that. In addition to that, a consequential amendment has also been done in 36(1)(4)(a), because where the employers will get the benefit of this additional NPS as a deduction in their returns. That means in the company's side. For the employee side, 80CC-D2 is permissible. Then there is a deduction in 80G, that is National Sports Development Fund, but that is for the old regime, because new regime we don't have any 80G. So overall, the impact of this is 17,500 rupees. In case we don't go with 80CCT2 or 1860, only with the new regime, the overall difference between the new regime is only 10,000 rupees. So if we add all these, that means the standard deduction plus 80CCT2, then the overall impact would be 70,500. So basically, they have done is that they are very happy to go with the new regime. That is what they are propagating. They don't want the old regime to continue. I will go with the next. So this is IFOS and other income. So here we have a very important change, that is abolition of angel tax. So there was an angel tax, that is a tax on the startup companies, which was bought in the year 2012. The idea to bring this and the purpose was that the difference between the share value and the share value issued, that means the fair market value, or what we call it as share premium, that was taxed at a notional value. And the reason was that the shares were issued at whatever rate or whatever price without giving actual benefit or actual reason to it. So what they have done is that initially this tax was only applicable to the residents whenever there was a share premium. That means the shares were issued in excess of the face value. In last 2 years, they also put this tax on the non-residents also. That means the tax
Recording in
this
progress.
is again for family pension only. Then there is another change in business head, section 28. This is for let out of property. So initially what we used to do is that we used to let out the property and we used to charge that income. That means the rental income was charged either in the head business income or under the head house property, depending on how the assessee wanted it, especially for the real estate people. Now what they have done is that they have specifically or clarified that this income, that is the rental income, which has come from the rental of house property, that is residential house property, will only be chargeable under the head house property. Now the problem or the benefit, what they used to do is that in case when they used to charge under the house property, obviously we used to get the standard deduction, and because of that, obviously the tax liability used to get reduced. Now, since Now the income will be taxed under the business that no benefit of standard deduction will be available. So this is the problem to real estate developers, especially because they had a stock in trade at the end of the year, and we are still, the government is, we have no clarification on this, that how the same will be dealt on. The other problem is that this property was only residential property. So in case the residential property, which is used as a commercial property, there is no clarification in this section, whether the same would also be considered as under the head house property, or the same would all still can go to business property, business profession as an income. This would also be applicable from April 1, 2025. Then there are two changes which have been done in section 37. One is that LIC, there were some expenses which were allowed to expend LIC. They were expenses related to capital expenditure, personal expenditure, CSR expenditure, and few other expenditures as has been mentioned in the memorandum. Now they have been disallowed in LIC business. Second change which they have done is that there was some legal contraventions which used to do, and we used to settle it by paying some amount expenses outside India. Central government has notified the same, and now the same has been disallowed under 37. So no expenses done for contravening any law paid outside India will be allowed as an expense under section 37. Now we go to the capital gain. So these are the capital gain is the one which are these are the most important and most prominent changes which have been done. And basically what they have done is that period of holding, they have changed into 2 only now. Basically, there were 3 holdings, that is 12 months, 24 months, and 36 months. They have done away with 36 months, though all the holdings have been divided into 2, that is 12 months and 24 months. So any listed securities within 12 months would be considered as STCG, above 12 months as LTCG. All unlisted securities, that is other than the listed securities, would have a holding period of 24 months for STCG and would have a holding period of more than 24 months as LTCG. So listed securities, unlisted securities would include, gold and other unlisted securities would include gold, your business trust, your any other assets other than those of listed securities. So there's a huge table. There's exactly the table where they have defined as which part would fall under the listed and which would fall under the unlisted. Besides that, the rates have also been tweaked. Now those rates for the long-term capital gain, which was 20% initially, has been for the long-term capital gain, which was 10%, has been increased to 12.5%. So for all long-term capital gain, the rate is 12.5%. So far as short-term capital gain is concerned, which is referred under section 11(111A, where STT is paid on equity shares. Equity-oriented mutual funds are there. Business trust, that means REIT and NBIT are also there. The rate has increased to 20%. Other than those, that means the unlisted equity shares, applicable tax rates. That means the slab rates would be normal provisions, rates under the normal provisions would be applicable. They have also brought about at par all the non-residents. So, all the taxes under 111A, AD, AP, E, 115E, 115AD, 115ACA, 115AD, all those capital gains or capital assets in the hands of non-resident has also been bought at par with the rate of 12.5%. They've also gone away with the indexation on the capital gain on the capital gain of immovable property, which would mean that if the immovable property, the rate would not be 20% and it would be 12.5%, irrespective of the fact whether the property is sold after 24 months or maybe 5 years or 10 years down the line. The only thing which would remain is that the FMV or the grandfathering, if the property is bought before 2001, then in that case, the property value would stay at 1st April 2001. So that would remain the fair market value as on 1st April 2001 would be there in case the property is bought before 2001. But there will be no indexation. Whatever the value is and whatever the current value is, the difference of that will be taxed straight away as 12.5%. Of course, if there are any other improvement or any other values which we have bought during the year, we can add that to the cost. Although there is no clarity on it, but we can still add to the cost if we have got the proper proof for that, and the value will be total of that. But there would be no indexation benefit going forward from 23rd July 2024 itself. They have also defined market links debentures in this, and they have also created a separate section for this, that is section 55A, 50AA, which applicable, this is for the short-term capital gain and unlisted debentures, bonds, specified market link debentures, and mutual funds. All are applicable, all are taxable at the slab rates under section 50AA. They have created a new section for this. So besides this, for F&O, the rates have been changed. Now, if you're going to do F&O, the rate was initial rate was 0.625%, and that the rate has been increased to 0.1%. STT has been charged. That means basically STT has been increased on future and options. This is the standard rate, and it is also available in memorandum. So I think these are all, it would be bringing a huge impact on everything. Tax, obviously the entire, plus in case of immovable property, the other impact would be that, the excess tax has to be there exceeding the limit of 54. So whatever 2 crore or 10 crore, depending on 54 or 54, that would be there. So in that case, additional blockage of funds would be there in case you purchase a new asset. Or, you can also opt for 54 EC, I think that is 50 lakh rupees, for purchase of mutual fund on the capital gain amount. So that is allowable. On the impact of other assets, the other would be that they have brought a clarity also on offer for sales. So that was not there, that is an IPO. So now indexation has been done away. So now they are saying that the offer for sales is at par with the 20% rate, that is short-term capital gain under section 111A. Besides that, they have also done the consequential changes in section 195(6) and 196B and 196C. This is in relation to the changes which they have done for non-residents. That is the capital assets which are held by non-residents. That is 115E, 115AD, which we are talking about. So I think these all are the changes. Of course, there are a lot of other impacts also, but going to, in the interest of time, I will first complete with the list of amendments, and then we can we can discuss other things. So now for TDS and TCS. So for TDS and TCS, every year we know that they bring about some changes. There is no year in which there is not a tweak in TDS and TCS rates. This year again, what they have done is that in these all slides, which you can see, I mean all the table which is there, these all rates have been reduced or to 2% as per the list 194D, DA, G, H, IB, M, O. In addition to that, they have brought one addition that is in the list, two additions in the list rather. One is that they have introduced TCS on sale of luxury goods, valuing 10 lakh rupees. So the luxury word is not there in the finance bill. The luxury word is there in the memorandum. So they have not defined what is luxury, but anything if you buy over 10 lakh rupees, cars were already there. Now anything you buy over 10 lakh rupees, there is a TCS of 1% on the sale. This will fall under 206C1. In addition to that, they have done few other changes. So one is that lower TDS and TCS certificates now can be applied for under section 194Q and 206C1H, which was not there. Under section 197, you can apply for lower TDS certificates in this case. For the file correction statement, which was there in TDS and TCS statement in 206C. So those you could have changed any time over the years, but now the time limit has been limited to 6 years only. And correspondingly, they have also changed that in case no order has been passed or order has been there, the order would also, the period of assessment would also be limited to 6 years also, or I think 7 years also, limited to 7 years. Plus, in addition, they have done that no order will be issued to any person who is an assessee in default in case he has exceeded the time limit of 6 years, or 2 years in the case of 2 years in the case of where the end of the financial year, whichever is later. They have also applied interest on delay, which the rate has been increased from 1 to 1.5%. In case of TDS on immovable property, there was always there was no clarity on the thought that whether this 50 lakh limit, that is a threshold on which TDS has to be deducted, is core property or not. So now they have clarified that. They have said that this is core property, meaning thereby that in case you have 50 lakhs threshold and each assessee, and there are joint holders, and each assessee, each joint holder has got say 25 lakh each, then that in that case also TDS would be applicable at the person at 1%. It is not that this is not qua assessee. The threshold which has to be seen has to be qua property. That means if the property value exceeds 50 lakh, then irrespective of the fact that your share is less than 50 lakhs, then also you will have to go with TDS in this. Other change which they have done in TDS TCS is 194J. So what they used to say is that there is a word defined work in 194C, and the same transaction is taxable under 194J also and under 194C. So they are saying that you have to test 194J first and then you have to test 194C. In case the transaction qualifies under 194J, then you go with 194J. That means higher taxes TDS is applied, and you have to go only in 194C in the remaining, that means the residual category, looking at the definition of work which is there in 194C. Now there was a prosecution element under section 276B, that is penalty clause. So now they are saying that in case you have filed the TDS statement of the last quarter paying with all the interest and penalty, then no prosecution is there. This is the welcome step. But again, in case only you have filed the TDS statement, in case you within the due date, in case you don't file the TDS statement within the due date, then this benefit or this immunity is not available. TCS credit. There was in salary what we used to have, we used to just have 192, that means TDS under 192 was allowed. Now what they have done is that in case we have TCS also, for example, we buy a we buy a car, so then there's TCS applicable. In case of LRS, TCS applicable. So all that cumulative TCS we can report it to the employer. Employer will correspondingly reduce that amount in the TDS, and the balance TDS will only be deducted under the head salary. This is again a welcome move. Then there is 271H. So they are saying that additional penalty will be levied in case the statement is of TDS TCS statement is not filed within 1 month, and the date of application is 1/4/2025. Now, for partnership, there are two benefits. Partnership, there are two changes. Of course, one is that TDS. So in case the remuneration is paid to the partnership firm, to the partners of the partnership firm. So no TDS was applicable initially. Now the threshold is 20,000. Over and above 20,000, 10% of TDS is straight away applicable on any salary, remuneration, interest, bonus, or commission paid to the firm of the partnership. This is 194T. This is a new section, a new addition in the 190 in the TDS house. So another change is that remuneration was stable for so many years under section 45B, the remuneration which was allowed to the partner. Now they have changed that remuneration. So initially it was 1.5 lakhs, or so that 1.5 lakhs or 90%, whichever is more, has been changed. That 1.5 lakh has been changed to 3 lakhs, and that 3 lakhs which was there has been changed to 6 lakhs. So this is a welcome move, and this was not there for so many years. So this was well expected. So this is now buyback of shares. So we have a buyback of shares. There are so in buyback of shares, what used to happen that whenever the company used to buy the shares were taxable in the hands of company under section 194, under section 115 QA at the rate of 20%. There was no tax in the hands of shareholder, and it was exempt under the hands of shareholders. Plus, TDS was required to be deducted at the rate of 10% and under the rate and the rates as applicable under section 195. Now, what they have done is that they have taken away this section, and they have said that in case of buyback of the shares, now the same would be taxable in the hands of the shareholder as dividend income. So the applicable slab rates would be applicable. That is one thing. Second thing is that this, whatever dividend, I mean, whatever buyback has been given, whatever you have obtained would be taxable as dividend, and whatever cost you have subsumed. So the sale consideration in this case would be nil, because all that income which you have got back as a share has been taxed as dividend. So the sale consideration would be nil. So whatever the cost of the share, that means the cost at which you bought the share would be considered as a loss, capital loss, and the same can be carried forward. So I will just explain you with one example. So for example, you know, there are 100 shares bought at the rate of 40 rupees. So the total cost of acquisition is say 4,000 rupees. 20 shares have been bought back at the rate of 60 rupees per share. So in that case, the deemed dividend would be 60 into 20, that is 1,200 rupees. Cost of the loss, that means we bought those 400 shares at the rate of 20. We bought that 20 shares at the rate of 40 rupees. So 800 rupees would be the cost of the shares. So the same would be carried forward later on. So for example, in the next year, you sell out 50 shares at the rate of 70 rupees. So those 50 into 70 is 3,500 rupees. And that 2,000 rupees, which was there, cost of acquisition of those 50 shares, that means 50 into 40 rupees, 2,000 rupees. So 50 into 40 is 2,000. So that is reduced from 3,500. So 1,500 is the cost of the value, that means the net capital gain. Out of this, 700 would be, out of this, 800 would be set off. This 800 is the buyback cost, which we have parked previously. So now this is how it is going to affect. This is under 222F, which is where the deemed dividend would be considered, and carry forward of loss is definitely allowed. I think in this this is applicable in the case of both listed and unlisted shares, and no taxes in the hands of no taxes or no withholding taxes in the hand of the company. Now, going forward, so these are the propositions for the international taxation. So, first is that foreign company, the rate was initially 40% taxable. The same has been reduced to 35% from this year. It's a welcome step. And this is done to obviously, to get more foreign investment and more foreign companies in India. Second is 44 BBC. This is presumptive taxation regime for non-residents. So there was the same was initially there in a shipping, whenever the shipping industry was taxable under case of non-resident, it was under 44B. Now they have created or carved out a separate platform for cruise shipping business. That is the one who are supposed to have a business or supposed to run cruise, only applicable for non-residents. So in case they bring about cruise business or cruise tourism in India, in that case, 20% of the total amount which they have earned in India, straight away 20% gross tax on that operating in India would be taxable. On the operating income would be taxable. On the gross income would be taxable in India. In addition to that, in case the rentals or the lease rentals which we have bought for that cruise, I mean the cruise which we have rented out or the property which we have rented out, and we have paid it to the non-resident company, which is again a sister concern of ours, that's a parent holding company, then in that case, that income is also exempt from tax in that case. It is on gross basis, and obviously we have done away with 44B in this case. Section 198. So this says that initially we used to deduct tax, whatever tax was there in the case of foreign company, FTC, foreign tax credit, we used to take it as a deduction in our Indian income taxes. Now, what they are saying is that corresponding income, we used to always take it as a net income, which is not correct. We always used to take it as a law says that you have to have the gross income corresponding to the foreign tax credit. So now they have clarified this, that whenever you are going to avail foreign tax credit on the incomes earned outside India, you will also have to take the gross income earned parallelly to this, and gross income less the foreign tax credit. So it will not be the net income. You will have to show gross income in your ITN. The other change which they have done is that 271 GC. So they are saying that initially there was initially in 271 GC. Sorry. So license office used to had to file annual activity statement with the RBI, I think within 60 days, and with the income tax department by 30th of September. Now they are saying that the same LO, that means the liaison office, has to report or give this annual activity statement within 60 days from the end of the financial year. So in that case, in case you exceed that, then there is a penalty leviable under section 271 GC, which is 1,000 rupees per day and maximum up to 3 months INR bond. Transfer pricing, they have introduced two changes. One is that they propose to extend the safe harbor rules by bringing the diamond business into it, which is always a welcome because we are mining business under raw diamond is a very huge business in India. So they are planning to bring under safe harbor rules. The other is that SGT, that is specified domestic transactions, they were not under the ambit of TPO initially. Now, during the TP assessment, SGT, if there are any SGT transactions, TPO can directly look after it and do the assessment there itself. IFSC, that is the GIFT city. So there are 3 or 4 amendments in IFSC. One is that there is section 94B. So this is limitation on interest expense. So limitation on interest expense, under this section 94, that is thin capitalization, the Indian company was allowed to deduct expense on 30% of the EBITDA, which it used to pay to its foreign holding or foreign holding company or the sister company. This was up to 30% only of the EBITDA. Now they are saying that IFSC, if you have a finance company which is located in IFSC, this rule is not applicable to it, and this is exempt from that 30%. Now the whole amount of expenditure which has been incurred as interest is allowed under 94B. They have also introduced, expanded the definition of specified funds under section 10(4)D, where they have added ETF and retail funds. They've also explained the definition under 1023EE, saying that recognized clearing corporation is the under IFSC will be exempted under 1023EE. In addition to that, there were some funds which were coming directly, like BCC, registered under SEBI. So they were exempt under section 68. No questions asked whether they were unexplained investments or not. Similarly, if there are any VCFs, that is venture capital funds, coming from or regulated under IFSC, that is GIFT City, then again they would also be exempted, or no questions would be asked, and they would be exempted under section 68 for bringing in funds into India. This is again a welcome move. So then there is an amendment in income tax clearance certificate. So under the black money income tax clearance certificate, initially we used to get income tax clearance certificate by going to the income tax department. Now they are saying that you will have to have one more you will have to get a clear get through from Black Money Act also. Without their permission, you will not be having that income tax clearance certificate. Basically, a no due certificate from Black Money Act also, that you don't have anything against in India for equalization levy. So equalization levy, as we all know, it was applicable under 2 EL1, which was at the rate of 6%, EL 2.0, which was at the rate of 2%. So now they have done away with the 2% rate that is on the e-commerce supply of services. But that 6% rate, which was there initially only on the advertisement, still is retained. That is one thing. Second, on the evaluation of FTS and royalty, this equalization level still persists. So only they have done away with the e-commerce supply. They have not done away with the total, not done away with FTS and royalty, and of course the 6% which was there in advertisement. It is a very good step, and probably this is the reason, because as we are going for pillar 1 and pillar 2, so probably they are doing away with this equalization levy and the abolition of abolition of angel tax also. The other thing which we have done away is that they have brought disclosure of foreign assets. It was mandatory to disclose all the foreign income and assets in the income tax return. Even the ESOPs, if we have got it from our foreign parent holding, then we were required to disclose the same in our ITR. Now that threshold of not disclosure was 5 lakh, and there was a penalty of 10 lakh rupees. Now they have increased the threshold of non-disclosure up to 20 lakhs. So you need not disclose if your foreign assets up to 20 lakh rupees in your ITR, and there is not, and they have done away with the penalty of 10 lakh rupees. This is applicable on ROR, that's resident and ordinary resident. For non-reporting of SFT, so we used to file that SFT, that is under section 285BA, we used to file that form. Now they are saying that in case you don't file that 285BA within the due prescribed date, then there is a penalty on the same. And plus there is also a penalty on the furnishing of inaccurate information or failure to comply. So now coming to block assessments and the assessment and reassessment. And of course, it is itself a complete Pandora box in itself. Lot of changes have been done in this. So I will just give you a bird's eye view. Of course, I would not be able to deliberate it completely. So they have said that they have aligned 148 with 148A. There have been a lot of changes in 148. So now they are saying that existing 3 years provisions have been extended to 3 years, 3 months. This is for less than 50 lakhs and greater than 50 lakhs. In both the cases, in less than 50 lakhs, the proposed amendment is 3 years, 3 months. In greater than 50 lakhs, the proposed amendment is 5 years and 3 months. In addition to that, CIT appeal. So CIT appeal never had a chance to set aside the cases. There were a lot of litigations pending with CIT appeals. So they could remand back, but they could not set aside. So now it's a welcome budget proposal by the FM, by the Honorable FM, that CIT appeal will get a chance to set aside the cases itself at its level rather than going to ITAT. And a lot of litigations will be mitigated at CIT level itself. The other change is that timelines for assessment of specific cases have been changed and they have been re-amended or re-changed. For example, condemnation of delay 12 months from the end of the financial year is furnished and case set aside by CIT now 12 months from the end of the financial year in which such order is passed have been changed. For block assessment, the block assessment was closed down or was stopped long back, maybe 7 or 8 years back. Now the block assessment has come back. Now they have again reintroduced this block assessment, and they've said that the 6 years, a block of 6 years, an assessment for search and survey cases can be done in the block of 6 years. And obviously 60% rate is prescribed for block assessment. Of course, we will have to see whether that 115 BBE, where the rate is 50%, has anything to do with it, because the impact might be different in that. Plus, there is no additional 234 ABC already there, and penalty would be there at 50% on assessed undisclosed income. That means if we are disclosing it, it is at the 50%, and if they are disclosing it, if the department is coming, that the rate is 60% of tax rates. Now, miscellaneous provisions. So, we used to get CBDT, we used to require CBDT under 119 to be for condemnation of delay and filing of returns. Now they are saying that those returns which have been filed under the condemnation of delay under 119 2B will have regular assessment under section 139. That means all queries and every return and notices and scrutiny, everything can come as a regular assessment to returns filed under 119 2B. So direct tax Vivad Se Vishwas scheme was initially introduced, I think 2-3 years back. Now they have reintroduced it, and the last date for I think December 24 is the date for the first installment to be paid under VSP. Aadhaar was not mandatory initially, only even the enrollment ID of Aadhaar card would do. Now they are saying Aadhaar number, you have to give Aadhaar number wherever enrollment of ID of Aadhaar application form is given. Benami law, they are saying that in case, there is any immunity from penalty and prosecution on Benami, and if you have disclosed everything, then there is an immunity on the same. That means you have to disclose and all the circumstances under which this Benami transaction was held, then you might get immunity from penalty and prosecution. Charitable institutions, again, it's a plethora of changes, but major change which they have done is that they have merged two sections. They plan to merge look-alike charitable institutions who have common purposes under one head. So they are saying that those two institutions can be merged together in case the purpose of those two charitable institutions is same. In addition to that, they are now empowered to condonation delay in filing registration application by trust. Approval-based exemption under 1023C is sunset clause. So now the same has to go to section 11 to 13, that is section 12 AA. So now in case 1023 registration is complete, I mean your registration is finished, then you can reapply in section under 11 to 13. 1023C is done away with. Of course, if you have a if the 1023 registration is still going on or may continue for another 2 years, I mean you have a validity still standing, then that will continue. Post your finishing of 1023C, obviously you can shift to 11C. Plus references of 1023 EA, ED and 46B have been inserted in 11.7, and registration of section 12A to claim exemption under 10 have been given. Plus this 12AC registration will facilitate the merger of the approval of where two institutions of same purposes are there. I think I'm done with all. Now, there are any questions or anything, please let me know.
Thank you for enumerating the budget proposals, ma'am, and decoding the same for all of us. I think your presentation was quite comprehensive, so most of the questions have been covered, although I'll still read them out once again for you.
Yeah, please.
So
I tried to, fasten it up because I knew the time allocated is some, and of course, there are a lot of deliberations and a lot of discussions on it, but I have just got a bird's eye. Yeah.
So the first question is from CA Tarun Dhingra, and he wants to know when the changes in the budgets are when are the changes made in the budget applicable from?
So, in this particular cases, for example, capital gain, it is applicable from 23rd July itself. So the changes have been clarified in the memorandum and the finance bill, the date of applicability for each and every transaction or each and every proposed amendment, the dates are different. And actually, the dates are only applicable once we get an assent from president. That means, the bill is signed. But I still have my dilemma that capital gain has started from yesterday itself. The capital gain transaction, the applicability of capital gain proposals have been from 23rd July itself. But there are dates which are different for every proposal. And the dates are already there in my PPT as well as in the memorandum.
Okay. So also somebody wants to know if you'll be sharing the PPT that we can check.
Yeah, definitely.
Yeah. And next question is from Ms. Radhika. She wants to, she's asked, can you throw light on amendment related to foreign asset disclosure made in the budget?
So as I already told you that foreign assets, even if you are an authorized signatory in any of the foreign account, even if you are a authorized representative of any trust, non-resident trust outside India, if you hold any bank account outside India, if you have any foreign assets related outside India, you were supposed to disclose the same in the ITR if you are a resident and ordinary resident, that is ROR. This particular disclosure is only applicable for resident and ordinary resident and not for NOR. So if you are a resident, generally what happens is when you are coming back from outside India and you become a ROR in India, so all the assets which were there in outside India, overseas assets which you have gained and all that income is required to be disclosed. So far as income is concerned, we were always disclosing it, adding it to the income and paying taxes on it. But so far as other assets which are lying abroad, generally assessee was not informed and assessee is now asked to disclose all that assets which are lying outside India. In addition to that, if your parent company or if your company has issued you any ESOPs or any shares in form of sweat equity shares, you are supposed to disclose those shareholdings in your form, IDR form, just as a disclosure. So now what they are saying is that disclosure limit was 5 lakhs and there was no penalty on it. In case the disclosure is not there and the value of that undisclosed assets is more than 5 lakhs, more than 20 lakhs now. So the penalty has been changed. Penalty is 10 lakhs, but the threshold of that 5 lakhs has increased to 20 lakhs. The only exclusion out of this is immovable property, where still you have to disclose this irrespective of whether the value is 1 lakh or maybe 20 lakhs. I hope I'm clear.
Yes.
And this is applicable from 1st October 2024.
I think this clarifies this question. And move on to the next question from Ms. Medha. She wants you to explain the provisions of buyback once again.
Okay, I will. So, coming to buyback. So buyback, what used to happen is that in case of buyback of shares, there was no tax which was leviable on the shareholder or the recipient, the person who used to give his shares back to the company. The tax was only in the hands of the company under 115 QA at the rate of 20%. Now what they have done is that those shareholders, when you are going to buy back the shares from the shareholder, the tax has been shifted from the company to the shareholder. Now the shareholder has to pay that tax at the slab rate, because the same has been considered as dividend income under 222F, and the same would be considered as dividend income under IFOS, that is income from other sources. So the slab rates would be applicable on that. That 20% rate which the company was paying has been done away. The other addition to that is that in case those shares, for example, you bought a share of 500 rupees. The company bought that share in 510 rupees. So that 510 rupees would be considered as a dividend income. Now that 10 rupees difference, which is there, sale consideration would be zero, because 510 we have already uh, taxed it as a dividend income. So there is no tax further. Now that 510 would not be considered as sale consideration. The sale consideration would be considered nil in the hands of the shareholder. And that 500 rupees, which you initially purchased the share, would be considered as the cost in your hand and would be considered as a capital loss in your hands. And that loss can be carried forward. And whenever you have any other short-term or long-term capital gain, the same can be set off. This loss can be set off against that. The TDS deduction from the part of company is also not there. No more. I hope I am clear. Is there still any confusion? I can still explain.
I think that was quite clear, ma'am. So just the last question from Ms. Archana. She wants to know if we can opt for presumptive taxation under 44 AD for intraday trading income. I don't think this was touched upon in the budget. So
yeah, this was not touched upon the budget. And so far as intratrade is concerned, 40 intraday you will have to consider it as a business income. Very clear on that. So far as intraday, no capital gain is to be considered for that. So now the question is that whether 44 ADA is applicable or not. Again, see, in intraday, what we do is that the total absolute value of the gain or sale, that is considered for the tax audit purposes. So, whatever the loss and profit are there, the addition of all that is considered for the checking out whether there is a, tax audit applicable or not. In case there is no tax audit applicable, I don't think so. 44 ADA is also allowed in that case, because it is purely a business income. It is not a professional income. So I think my personal view would be that you will not have to go with 44 ADA. The option is that you can go with 44 ADA and pay 6% tax even if there is a loss. Or alternatively, you calculate that absolute value and it crosses the threshold limit, then you go to the tax zone. I hope I'm clear.
Yes, ma'am. Yes, I think we are done with the questions. So thank you, Smita ma'am. I once again thank you on behalf of the Women Members Excellence Committee of ICI. And thank you for deliberating on the direct tax proposals of the Union Budget 24. I now hand over to CA Ragini for introduction of our next speaker.
Thank you very much. Thank you.
Ragini, you'll have to unmute yourself.
Good afternoon. At the outset, let me welcome the next speaker for this upcoming session on GST professional opportunities. And when it talks about works contract industry, it is something really interesting that we hope is coming up. Welcome, Shubha ma'am. We welcome you to this session of Yashaswini organized by the Women Member Empowerment Committee. And I would like to introduce CA Shubha Rawat to the audience here. CA Shubha Rawat is having an experience of 12 plus years with indirect taxation, and she is currently the head of indirect taxation at Otis Elevator Company, India Limited. She excels in navigating complex tax landscapes, ensuring compliance, and optimizing tax strategies. She is also a dedicated advocate for diversity, equity, and inclusion, leading initiatives that cultivate an inclusive workplace culture and equal opportunities. Additionally, she contributes to CSR efforts, focusing on initiatives that support community impact and sustainable development. And that's too humble a profile for a personality like Madam Rawat. We are glad to have you here, ma'am. And without much ado, may I invite you to take up the session with regard to the works contract industry, professional opportunities in indirect taxation.
Thank you. Thank you so much. Am I audible?
Yes, ma'am, you're audible.
Is
We
my
can hear you.
PPT visible?
Yeah, you are very well visible and clearly audible as well.
And my PowerPoint is also visible. Presentation is also
Yes,
visible, right?
we can see it. Yes.
Okay. Thank you. Well, good afternoon, all the wonderful women. I'm sure you all must have enjoyed this budget session, which was very insightful. And now we'll discuss about the professional opportunities in works contract industry, specifically in the indirect taxation. Well, you must be wondering why I have chosen this topic. Well, the answer is that unlike pure goods or pure service industry, this industry gives you a flavor of both goods and service industry. And that is what it makes it little different and interesting. Now I want you all to put your seatbelts and let's ride this roller coaster journey, which will first explain you about the ride, means what is works contract, its birth, that is pre-GST, and how it developed, how it matured in post-GST after encompassing all pre-GST challenges. Let us first have the overview of the works contract. Well, this works contract is for having any works contract, there is an agreement. And in agreement, if you see, there are a lot of the scope of work is mentioned, terms of payment is mentioned, and delivery timelines is mentioned. Unlike other works where works gets completed within some period, this works contract it basically most of the time it falls under the continuous supply of service. Means work completion may take more than 3 months. Okay, and accordingly there are different kind of criteria for defining the terms of payment, time of supply, time of issuance of invoice. Everything differs in case of works contract. Now let us understand. After this, I just want to explain that how this happened, about its birth in the pre-GST. Well, as you know, pre-GST there were multiple taxes, and therefore for works contract industry that has both goods and service component, VAT and service tax was charged for material and labor component. Though law has given some guidelines for standard deduction, but still, there was a lot of challenges, and how much should be the material portion, how much should be the labor portion, and all the case laws, all the litigations were open in this regard only. In fact, I would say that even today also, this is the pre-GST open cases are there, where there is still a litigation open that how much should be the material portion, how much should be the labor portion. If material is moving from one state to another state, how much portion should be leviable to CST. So these cases of pre-GST are still there in multiple industries which are open. And that is why I have introduced this pre-GST, because this is another area of where I would say that CA is required, where we are supposed to litigate before the authorities and for our clients. So that is why, even though we have moved to GST, but pre-GST legacy cases are open, and these are the litigation. And definitely, this is the another area of opportunity for CA fraternity. Now let us understand this, how this pre-GST baby turned into a mature person in GST regime. Well, when we moved to GST, after introduction of GST in works contract, the one thing which they have clarified is that works contract will be a service. So this was a big sigh of relief for everyone, because now the problem which was of bifurcation of material and labor is over. And that's what it has made it, that it is now it's only a service. Because of that, the all the challenges regarding bifurcation is over. Now let's look into the definition of works contract industry, how it has been evolved over the period of time. Well, works contract industry is basically, it is talking about, I would say that we all know that what is works contract a little bit, that whenever it is material and labor component is involved, it is a little different nature, it will fall under works contract. But there's one more thing, it may also fall under the composite supply, right? So the difference between the composite supply and the works contract, a very thin difference is that if composite supply is in relation to immovable property, it takes the nature of works contract. And once it becomes the works contract, then obviously it come out of that composite supply character, and it becomes purely in the nature of service. Now let's understand that which all industries, what are the scope of works contract industry, which all are the industries which are actually impacted because of this works contract. So I would say infrastructure, real estate, elevator, escalator industries. These are the industries which actually offer diverse opportunities for CA in the works contract sector. And definitely we have a different kind of valuation mechanism also in the works contract. If we talk about so works contract, we have real estate also in the works contract, we have elevator, escalator industries also in the works contract, we have infrastructure also in the works contract. If we talk about the valuation, if let's say if the transfer of property is also part of when let's say when it is dependent whether the contract includes transfer of property in land as a part of the works contract. So in case of supply of service, if it is involving transfer of property in land, as the in that case, if it is also including transfer of property, also in that valuation, that transfer of property will be excluded from the supply of the service to the extent of 1/3 of the total contract value. This is how the valuation in this case is being done wherever transfer of property in land is also a part of supply of service. Now let's look into the next thing, which is ITC. So as we all know about section 17 subsection 5, which talks about ineligibility of the ITC, input tax credit. One thing is clear, that one particular provision, that if any services you are providing for furtherance of providing this service to somebody else, then obviously you will be able to take the credit. The similar is applicable for works contract as well. And here also they are saying this thing, that in case if works contract services, when we are availing these services and we are further providing these services, then the person who is availing can claim the credit. Otherwise, it is not eligible for claiming the credit. But there is some exception, like for if it is other than plant and machinery, then definitely you cannot claim the credit. If it is related to plant and machinery, you will be able to claim the credit. For example, let's say there is a contractor, okay, and I am a contractor, and I have availed the works contract service, and then I have further provided this services to somebody else. In that case, I as a contractor will be eligible to claim the credit. But the person to whom I'm providing, let's say if I provided these services to some shopkeeper, okay, for constructing the elevator or anything, then that shopkeeper will not be eligible to claim the credit. But I will be able to claim the credit because this is my business, my profession. So whatever is related to my business, I will be able to claim the credit. Okay. So now let's understand how it is different from other industries under GST. So as we all know that it is works contract, when it is bundled together goods and service, it is known as service. But in other industries, goods will be considered as a goods, service will be considered as a service. Similarly, if we see about the revenue recognition, if we talk about GST, okay, in case of GST, there are one more important, which is I would say invoicing. Okay, in case of works contract, and if it is under continuous supply of service, you are supposed to issue the invoice based on the terms of payment. For example, if the terms of payment is like 10% advance, 50% on delivery, and after that the balance is on the installation, something like that, then accordingly invoicing will happen as and when that particular terms of payment will be due. Unlike other industry where your time of supply will be completed as and when you have supplied that goods and services as a whole. So that is what it makes it little different, because here it is the provisions and the clauses that first will be continuous supply of service. Similarly, if we talk about the place of supply, even here also place of supply, if I talk about what is important here, is this place of supply of immovable property will be considered as a place of supply. So whatever is the wherever your immovable property is located, that will be the place of supply. And that is what we have seen in the cases of hotel as well, right? Where, let's say, even if you're availing any services of hotel, and you don't have GST registration in that particular state where hotel is located, obviously you won't be able to get the credit, because it is the place of supply will always be that place where the immovable property is located. Now, the third challenge which is there is that if we talk about GST reconciliation, GSTR 9C that we are doing, right? In that also, in case of works contract, there are challenges when we do for the revenue reconciliation with the GST turnover. So start revenue reconciliation and GST revenue reconciliation is again a challenging task in case of works contract, because as I have told you, in case of works contract, the contract runs over the years. And in that case, it becomes really difficult that how much that it's really difficult to reconcile GST revenue with the stat revenue, because stat revenue works on revenue some other principle in days 18. Okay, whereas here if I talk about revenue recognition in case of this is basically other industry follow AS 18, but here it is being followed percentage of completion method. In case of works contract, construction industry and real estate industry, we follow percentage of completion method. That means as and when your cost is incurred, only then you will be recognizing the revenue. However, if we talk about GST revenue, you will be recognizing or as and when you are issuing the invoice. So there will be always a huge gap between the revenue which is being recognized on percentage of completion method and the revenue that we are actually issuing based on the GST. This is what making it a challenging task, and I would say again an opportunity for a CA profession, because the reconciliation activity itself is a very complicated task, and definitely a CA person is the better who can actually do this reconciliation and can identify how much to be identified under unadjusted advances, unbilled revenue, and various other categories to do this reconciliation. So now let's move to the next section, which talks about challenges. Okay, now we have understood that, okay, fine, we have moved from pre-GST to GST. It has been matured, and we are expecting that fine, there should not be any much challenges in the GST regime as far as works contract industry is concerned. But what do you think? Is that a true thing that there's no challenges even today? Well, I would say yes, challenges still exist, and it is with regards to various areas. So one is, I would say, wherever lower rate of tax. If you all are aware, in the beginning, in July 2017, when GST was introduced, government has given some benefit of lower rate of 12% to this works contract industry. Okay, that if you are issuing, if you it's a for government customers, or if it is for single residential customers, or for some historical monuments, metro rail projects, the government has given those 12% benefit, which although they have removed all those benefits in July 2022, but yes, earlier these benefits were there. But because these benefits were there, people have availed those services, and they have actually issued invoices with the lower tax rates to their customers. But now what is the challenge? The challenge is that now authorities are not accepting those things, and they are saying for some kind of industries, although they are part of works contract, according to them, this 12% benefit is not applicable, and this is again has become one of the litigation, and everyone is struggling for this particular issue, because they have given this benefit based on the notification, but now the litigation which has been opened up is on account of this lower rate of tax only, which according to the officers, it's no more applicable on certain kind of industries. Now, moving to the next one. Next one is regarding the ITC eligibility. As we have already told that ITC eligibility is again challenge, because it becomes difficult for the industry to explain that whether this ITC will be eligible or not. For example, let me give you one particular example. For example, there is a escalator or elevator which you are using in your residential apartment. Okay, many societies are availing that credit, but are we eligible to avail that credit? Is it okay to avail that credit? Is still a question mark. Okay, because again there are different parts in this. Let's say at the time of installation, can you avail the credit? Can we say it is a part of plant and machinery, or uh, or can we claim the credit not at the time of installation but at the time of AMC, by virtue of saying that because there are three parties involved. One is builder who is one is the industry which is providing this AMC service, and then society is further giving these services to their members. Because society is availing and further giving it to their members, then society should be eligible to claim the credit. So this is also one of the litigation which is opened up, and there are few people who are taking the credit and there are few who are not taking the credit. But the judgments, they have few judgments also have come, but still the judgments from higher authorities have not come in this regard yet. So, so the question is again, there was one more issue which I have already told, that reconciliation between the GST turnover and statutory turnover is also a challenging task in this industry, and definitely everyone is trying to look or figure out how best they can do to correct this particular issue. As we have already told, that opportunities for chartered accountant, wherever there are challenges, definitely opportunity for CAs come. And in indirect tax specifically, I'm not sure how many of you are belongs to this indirect tax fraternity, but yes, we all know there are a lot of opportunities for the indirect taxation for CA, because the kind of challenges that we are facing and what we have thought that how GST would be is exactly not the way GST is, right? There are a lot of reconciliations that we are doing. There are a lot of other challenges which everyone is facing from industry to industry, and a lot of DGGI summons, audits from multiple authorities. These are all are actually becoming very challenging for anybody, and definitely this invites the opportunity for chartered accountant. Um, as we know, this particular sector is this. If I talk about the Indian construction industry sector, this is growing at a growth rate of 5.4% from 2000 during 2023 to 2007, and this we are expecting because government is going to give more initiative. They have already announced a lot of budget initiatives as well for the infrastructure sector, construction sector. So definitely this is a booming sector. These are the compliance requirements for works contract cases, which is similar to other industries as well, where you have to go for the registration, invoice issuance, return filing, payments. Except invoice issuance method, all other methods are same, which I've already told. Invoice is issued based on the terms of payment. So this is the only difference that it has as far as this compliance requirements are concerned. So that's the key takeaways. As a CA, we are supposed to ensure that we are doing proper tax planning and ensuring compliance. And yes, advisory is required as far as the eligibility of ITC is concerned, as far as the reconciliations are concerned, lower rate of tax, and there are some various open issues which regards to pre-GST open contracts, which we have moved which has been transitioned to GST, which is again a next challenging task while facing before the auditors. So definitely that also requires attention of a chartered accountant. So this is all from my end. I hope you all have understood the session. So any Q&A is definitely invited. Yeah, thank you so much. Ragini, you're not audible.
If we could have CA Pooja, maybe we could have some questions.
Yeah, sure. There are no questions as of now.
Actually, ma'am, it's a very, very complicated topic. I myself am practicing in indirect taxes at Guwahati. I am presently the vice chairperson of Guwahati branch also here. And my core practice is in the area of GST. And this is one of the most, I believe, complicated, complex areas in GST. We are presently, ma'am, one issue wherein I would like to have the chance, since there are not many people asking, I am taking this advantage of asking a question. There are a number of government contracts. Recently, in the year 2022, the rates for various government contracts, which were earlier liable for 12%, were made to 18% from July 22 onwards. Now, there are many contracts under which the tenders were floated and maybe the tenders were allotted also at 12%. And after that date, the contracts became liable for 18%. Now, especially in Assam, we are seeing that in most of the government contracts, the contractors are not able to get the differential tax reimbursement from the government entities. So, what do you suggest is I do not find any particular circulars or instructions issued by the council or the government to ease out this situation or to give the benefit of the differential tax to the taxpayers at large. And this is a very big amount. So some
I
of them have given it, whereas some are not giving it. There's no uniformity. How do we address this situation?
See, Ragini, just because this situation is not a different situation, government keep on changing the rate of taxes that we all know, right? And it may happen in future also from 18 also it may go to somewhere else. We don't know. And that is why to avoid these situations, there are some conditions which are being mentioned in the contracts while signing the contracts, which actually covers all these kind of situations, and that makes you legally also I mean you can enforce the other entity legally also if you mention that in your contract terms. But if it is not being done, because it is generally most of the industry they do mention this thing that if any increase or decrease in the rate of tax will have to be considered by the concerned person. So this is how it is clearly mentioned. But if it is not, if it is mentioned, definitely you can legally enforce and that particular party. If it is not, then yes, then we don't have anything rather than to
See,
instruct
ma'am,
the person or
actually, what happens, ma'am, in these contracts, these are standard language contracts which are enforced by the government themselves, and the contractors generally do not alter or cannot alter the terms. They have to sign the standard agreement which exists. Now, these contracts mostly say the amount is inclusive of all taxes. When we read inclusive of all taxes, I believe we understand that it is inclusive of all taxes which are applicable on that particular date. So, is there any particular judgment of a higher court or maybe an instruction which says that if there are subsequent rate changes, they will not be included in an all-inclusive contract or something is what we are looking forward to? Is there something like
no,
that?
no, nothing as such on this.
Unfortunately, we could not
Unfortunately,
find
nothing is
any
there.
such thing. Yeah.
Yeah.
And
It's
that
the
is the
only
cause of.
ways you can just insist the customer if that is the case. I mean, based on your personal relationship and everything, if you can get this done. In my company, we have not faced this situation so far. But definitely what you are saying, I agree. This could be one of the
GST neutralization actually should be in a standard instruction manner for government entities so that the contractors can file. They can actually file the neutralization certificate by chartered accountants and they should be able to claim, but many claims are pending, unfortunately.
Yeah, definitely. Agree. Correct. Okay.
That was on my part. Pooja ji, you can take it over from here.
Sure. So, ma'am, there's one question that what types of recon have or reco issues have happened? This question is from Ms. Meda.
Okay. So the reconciliation issues that I was specifically explaining with regards to works contract industry is basically, as I've told you, that revenue when we book recognize in the statutory books. Okay, so basically revenue recognition principle itself is different in the works contract, which talks about, because works contract is majorly in the construction industry, majorly. Okay, So in the construction and real estate, we all know that there is a different accounting standard that works, which says that it will be on the percentage of completion. Means if you have incurred the cost of 10%, okay. So what happens? I have incurred the cost, let's say 10%, but I have issued the 100% invoicing, right? I could get the advance invoicing, or I've issued invoice, GST invoice to the extent of 100%. My contract value is, let's say, 10 lakhs. Out of 10 lakhs, 10%, which is 1 lakh, I have incurred as a cost. So as per the percentage of completion method, only to the extent of 10% I can recognize the revenue. Okay, so let's say I have recognized the revenue of, let's say, 10 lakhs, 5 lakhs, I have recognized the revenue. However, in contradiction to this, I have issued the invoice, GST invoice, to the extent of 80% or 100%, which is of exactly 10 lakhs I have issued. But if I see here in the books, it is 5 lakhs, but in the GST turnover, it is showing as 10 lakhs. Okay, as you can see, there will be a wide gap, and this wide gap will continue for years, because let's say if the contract is for 3-4 years, for me, GST revenue is already done in this year, but in the stat books, it will run over the 3-4 years till the time I don't complete the contract. So that is why, if we see, either a amount will be part of unbilled revenue, or it will be part of unadjusted advances. It is easy for those industries for which it is only 1 or 2 contracts on, it's a because if we talk about the real estate, there might be not much challenges, because they have different entities. But if we talk about the elevator or works contract industry, they have multiple contracts, and in multiple contracts, identifying how much is related to previous year, how much is related to this year, how much will go in the unbilled revenue or unadjusted, it becomes a very challenging task.
Okay. There are not any further questions. So I would just like to conclude this up. So on behalf of WMC and all the listeners, I would really like to thank CA Shubha Rawat ma'am for apprising us on this wonderful topic. On behalf of WMEC, I would also like to thank and to convey my gratitude to Preeti ma'am and Kamisha ma'am for starting this amazing initiative of Yashaswani. And my very sincere thanks to all the listeners who could take out their time today and listen to these two wonderful speakers. Thanks, all of you.
Thank you so much.
Thank you. Thank you.